Principles of Accounting, Chapter 12. In Chapter 12, we create the statement of cash flows. So we look at what the purpose is of the statement of cash flows and how we prepare a statement of cash flows. What people outside of the company use the statement of cash flows to do is look at the cash flow of a company. How much cash do they have on hand? Where do they receive their cash? How do they spend their cash? It also explains the differences between net income and cash flows because of non-cash expenses such as depreciation, and the change in the cash balance on our balance sheet from period to period. We use the statement of cash flows to decide if a company has enough money on hand to pay its debts, their ability to pursue any opportunities that might come up. So, what do they have on hand to be able to pay for new opportunities, their day to day operations, how they make long term investment decisions. So we look at a company's cash flow structures and how their cash flows to see where they have liquidity issues, where they have issues paying off of their bills, if they have seasonal activity due to the nature of their business, and are they going to be able to pay back any financial obligations they might have if they take on long-term debt. Cash equivalents are one of the things in cash flows. So cash equivalents, if you remember from previous chapters, are short-term, highly liquid investments. They are quickly converted into cash. So we sometimes on financial statements, you will see cash and cash equivalents, and businesses will put them together in one line. So that's how easily they are converted to cash. When we are creating a statement of cash flows, we have three sections. The operating activities. So operating activities are how we operate on a daily basis, the things that we do to run our business. Investing activities. This is where we as a company invest our money. Sometimes this is a hard thing to think about when we think about investing as a personal thing. So if I invest, I'm investing in the stock market or investing in bonds. For a corporation, if they're investing in themselves, they're buying new equipment, they're buying new property. What their financing activities are selling stock on the marketplace in order to finance their operations, or selling bonds on the marketplace, or taking out long-term debt. First, we're going to look at operating activities. So operating activities are the cash we receive and our cash payments out. So what money we receive from selling our goods and services, from our actual operations, if we receive money in interest and dividend payments from various investments, and all of our payments out. Payments to our employees in payroll, payments in accounts payable, and paying current obligations, income taxes, and interest. The cash flows from investing, these are cash proceeds from collecting principal on loans and from selling investments and plant and intangible assets, or cash payments out to buy more property, plant and equipment, intangible assets, investments, or paying money out to borrowers. Financing are proceeds from short and long-term borrowing. So this would be a notes payable, and cash received from owners for issuing stock. There are also the cash payments that we give out, such as cash dividends or repayment of loans, with the exclusion of interest payments, because interest payments go in the operating activities section. So when we break down our balance sheet, we have that current assets and current liabilities go in the operating section of a statement of cash flow. Long-term assets are property, plant, equipment, and intangible assets go in the investing section. And long-term liabilities and equity belong in the financing section of a statement of cash flows. We would also have any non-cash investing and financing activities. So those non-cash financing activities are usually just part of a note to our statement of cash flows, where we would put a note underneath and show this. So we have like retirement of debt by issuing stock, conversion of stock, if we lease assets in a capital lease transaction, purchase long-term assets by issuing a note or a bond, or other things that we do that we don't actually exchange cash with anyone. When we create the statement of cash flows, we start with the operating activities section. So we list the inflows and outflows of cash for our operating activities. Then we have our net cash provided or used by operating activities. Then is our investing activities section, followed by our financing activities section. We then have the net increase or decrease in cash. We have the cash from our prior period, so beginning cash plus or minus our net increase or decrease in cash is our current cash and cash equivalents at the end of the period. We would need a separate note or information disclosing any non-cash investing and financing transactions. When we prepare the statement of cash flows, we go through these steps. First, we want to compute what is our net increase or decrease in cash. Then we look at the activities that give us cash. So what is the cash that we received from our operating activities? What's the cash we received from our investing activities, then our financing activities, and then we prove it by making sure that what is our operating activities plus our investing activities and our financing activities equals that net increase or decrease in cash overall. We can start by analyzing the cash account. So when we look at the T account for cash, we can see various items here where we have receipts from customers, receipts from sales, receipts from cash issuance. We see that we had a beginning balance of $12,000 and an ending balance of $17,000, and we paid cash out for various items: inventory, interest, taxes, expenses, notes, and dividends. When we look at the cash account, we have cash equals liabilities plus equity minus the non-cash assets. So we also can look at non-cash accounts. The items that we need to prepare a statement of cash flows are our balance sheets. So 2 periods balance sheets, the before and after, a current income statement for the period, and any additional information we might have about sales of assets or sales of stock. When we prepare the cash flows from operating section, this is an example of an indirect method. So we have 2 methods of preparing a statement of cash flows. The first method we're going to look at is the indirect method. Then at the end of the chapter, we'll look at the direct method. We start with net income. In the indirect method, we start with net income. We then make adjustments to net income based on our operating activities. So we have the increases or decreases in current assets and current liabilities. And then we add back non-cash expenses such as depreciation expense. And then we look at loss and gains for any kind of loss or gain that we have. So if we look at this next example, we have comparative balance sheets, and we have an income statement, and we have some additional information. So we see that we have a $5,000 increase in cash, $20,000 increase in accounts receivable from 2018 to 2019, $14,000 increase in inventory. So we look at the increase or decrease from year to year in all of our accounts. So what the statement of cash flows is looking at is explaining this in cash flows. We also have our net income, and then we have other information. Accounts payable balances are from inventory purchase. We bought plant assets by issuing notes payable. So we didn't pay cash for those, but we do have a new note. So we would have to disclose that. We sold plant assets, we received cash, we had a loss, we received cash from stock sale, we declared and paid dividends, and we paid cash to retire notes. So when we're going to use this information throughout the entire statement of cash flows. So first, we prepare the operating section. So our cash flows from operating activities. So we have the adjustments to net income. We add back depreciation expense. Then we also have the loss and gain on the loss on the sale of plant assets and the gain on the retirement of notes. Those don't affect our cash. Then we have the increases and decreases in our current assets and liabilities. So we subtract increases in current assets. We add decreases in current assets. We add increases in accounts in current liabilities, and we subtract decreases in current liabilities. We get net cash provided by operating activities after we do all of this of $20,000. We can then see that we have adjustments. So first we start with those adjustments for income statement of items not affecting cash. So expenses and losses with no cash outflows are added back. Revenues and gains with no cash inflows are subtracted. This is a very handy table for creating the operating section using the indirect method. It tells you whether you need to subtract it from net income or add it to net income, depending on whether it's an increase or a decrease in current assets. So then we see that section where we have the increases and decreases in current assets and what is added and what is subtracted. So keep that slide handy, keep this graphic handy in your notes for when you are working on your homework and for the exam. So our adjustments for the indirect method are adding back non-cash expenses and losses, subtracting non-cash revenues and gains, and then either adding or subtracting changes in our current assets and liabilities.